is Ed Siddell, President and CIO at EGSI Financial. Ed, welcome to the show.
Thanks for having me back.
So Ed, what does July's PCE report that was out this morning tell us about the state of inflation?
Honestly, that it's holding steady. I think the impact that everyone was expecting from tariffs really never happened. And Powell really even alluded to it during his speech at Jackson Hole, in which he became very dovish as it relates to lowering rates in September. So I think we're on the right path. Inflation is it's still growing, right? It's just not at the rate that it once was. So the rate of growth is lower than it was last year, and we're on the right path from an economic standpoint.
And how much weight do you think the Fed is going to be putting on today's result?
The core PCE is really the main thing that they focus on. They have been focused a lot on jobs numbers, but as we've come to realize over the last couple of years, they've not been as reliable as they have in the past. So they're really focused on the PCE. And I think that that's going to be the one thing that they're going to depend on to give them the ability to lower rates. I think that they're only going to lower rates 25 basis points in September. I know others are expecting higher than that, but if you look at what the market is priced in, it's only 25 basis points, and we agree.
Another piece of hard data, the August jobs report, is due a week from today. Given the sharp downward revisions in recent months, what should investors be anticipating?
Honestly, we don't believe they're going to put a whole lot of weight on it because it's not just over the last couple of months. If you look at the downward revision over the last several years, month over month, the continued downward revisions, investors, the markets, they've taken a look at it and realized that it is not as impactful and they're not reliable. So I don't think it's going to have an impact at all.
So investors are pricing in a strong likelihood of a rate cut in September. I just looked, it's over 87%. How many cuts do you anticipate before the end of the year?
We see at least one more after September. We think that there's going to be a total of 50 basis points. But depending on the economic data, if it continues in the direction that it is, we could see an additional 50 basis points for a total of 75 by year end. But honestly, we're expecting a total of 50 basis points this year.
All right, so the S&P is coming off of a record, but do you anticipate that we're going to see some pullback in the markets?
We do. We think that there is going to be some profit taking over the next 45, 60 days. But we do believe the market is going to finish around 66 by the end of the year. And that's really going to lead into next year. And the big reason for that is deregulation, the rate cuts. And this is really what investors are looking for going forward. So as soon as we start to see those rate cuts come through and there's some validity to that, investors are going to start reinvesting. But really, when we see that pullback, that's really nothing more than opportunity going forward.
Ed, there's so much going on in the markets and the economy right now. How are you advising your investors?
Well, for us, we have a very diversified portfolio. And even if there's a pullback, cooler heads prevail just based on how we do this. And because we use a very strict investment plan going forward, and some of those sectors that we like that are going to be good buys now and going forward, we still like tech. We still like AI. We think that there's, 7 to 8 years of continual run up there as well. Some of the other sectors that we really like are financials. We think that those are good values going forward, especially as deregulation continues to happen. And the big thing for us are small caps. When we see the run up in small caps from April 8th to now going forward, remember, this is the bellwether for the economy. And what this is telling us is that the economy is heading in the right direction.
And I understand that you see the S&P topping 7,500 by the end of 2026. What is fueling your optimism there?
Lower fuel costs. We are a petroleum-based economy. The gas fuel is at its lowest point in 5 years. Deregulation going forward, the OBBBA the one big beautiful bill, lowering taxes, which is putting more money in consumers' pockets, and it's going to give them the ability to spend. As we have continued lower interest rates, we think the rates are going to continue to lower going next year by at least another 50 to 75 basis points by next summer. And this is just going to spur on economic growth. So the more disposable income that people have, the more spending, and it's just, especially with small businesses. As rates get lower, now they're going to be able to afford those SBA loans and grow their businesses, create more opportunities for employment going forward.
Thank you to Ed Siddell, President and CIO at EGSI Financial.
Thanks for having me. I appreciate it.